Hello, everybody. My name is Ryan Schul. This is my channel. It's devoted mostly to data science, machine learning. I also talk about deep learning, artificial intelligence, optimization routines. I get into some of that stuff as well. I have several videos focused on financial investment, asset management, portfolio management, back testing, forecasting, things like that. So I have a variety of things. I focus a little bit on financial topics in data science, but it can be anything from clustering, classification to regression to multiple regression and linear regression, random forest, XGBoost classifiers and regressors, and all kinds of fun things. Okay, so today I have a really cool video for you. Now, I'll admit there's good ones and there's bad ones. I don't think there's any bad videos. I'm not putting out garbage onto my site and expecting you guys to waste your time with that. But I think some are better and some are pretty good, kind of mediocre, a little bit leaning towards decent, maybe a little bit mediocre, but some just have to be better than others. They can't all be phenomenal, right? There's got to be some good ones, slightly less good ones. But this one I think is very excellent. So through to the end, we're basically going to look at a bunch of economic indicators. We're going to fetch a bunch of data from the web and then do an analysis on this and try to use different economic forecasting data sets like unemployment, inflation, T-bills and T-bonds and T-notes and things like this to predict future stock prices. Okay, so it's going to get pretty cool pretty quick. Okay, so sit tight and stick with me to the end. We can dynamically retrieve a lot of information from the web. We can get 1, 5, 10, 30-year Treasury yields. We can get GDP growth rates. That's exactly what we're going to do. Inflation rates, we got that. Unemployment rates, sentiment indicators, we have that too. We're going to get a lot of things from Yahoo Finance as much as possible. That's a great resource. You can pull that in right here. This one-liner will give you access to all the resources on that Yahoo Finance API. It's very cool, but some things you just can't get there. They don't cover inflation, unemployment, GDP. It's not that kind of site, but we can procure those data sets from other sites and merge everything together. So the first thing we're going to do, and I'm not going to run this, by the way, because one of these data sets requires me to import my Fred API. Let me skip to the end. It's probably better to show you this now rather than later. If I can, why is it getting stuck there? Okay, thank you. I love it when the computer does what you tell it to do. When it doesn't do what you tell it to do, it's kind of frustrating. So here's the Fred API. You can go here, get a free API key. So I would encourage you to do that. Once you get that, all this code will run perfectly fine. I am not going to run the code because I can't share mine with you. But when you go here, there's something here, API or something. Did I spell it? Did I spell it right? API. No, API. So you have the categories, related series tags, everything is in here. Okay, so go ahead and get that API key when you get a chance and everything will run fine. Now, aside from that, that's the only thing you need, the API key. Everything else is going to come from Yahoo Finance. So I'm going to pull in some data here. This is GSPC. This is the S&P 500 index, right? If I go to finance by Ann, this should come up. There's Tesla. So I looked at that recently. So you're going to have a ton of information here, including some bond data, not a whole lot of bonds, mostly equities, ETFs. Whoops, what was that? ETFs and yeah, here we go. Had to wait. There was a delay. Pricing. The S&P 500 data going back 120 months, so it's 10 years, okay? And we're also going to get the TNX data. This is the macroeconomic indicator 10-year Treasury yield, okay? So if we go over here, we can get this guy right here. We're also going to get that for 120 months, okay? 10-year yield. So this is one macro indicator that we're going to analyze. And we are going to merge everything together based on the date of the data set. So I'll show you how to do that. That's why I think this video is very cool. We're touching on a lot of very interesting, very relevant topics, and we're going to merge everything together based on the index, which is the date in the data frame, because some data frames or some data sets are a little bit older. One stops at December 31st or December 1st, I think, 2023. So it's a little bit older. We're in January 2025. So it's about just over a year old, a year and 1 month, a year and 2 months old, something like that. But that's the most recent we can get. And if that's all you can get, that's manufacturer date. I can't, I can only get what's out there. So this is the TNX. We have that. We have the S&P 500. We're going to merge these together in a combined way. PD merge will do this for us. We have the left and right index, right? So we're merging the date. So we have 1/1/14 and 2025, and oh no, this is 2015 because that's the head and the tail is at the end. Okay, but just trust me, we're going to merge together on the dates. That's what this is for. This one line of code will do the work for us. And of course, you can Google this. This stuff I think is very interesting. Okay, these videos are instructional to help you to learn and to help you to figure out what to do. So it's educational and informational too. Right, so it's excellent to know how these things work. If you just run the code blindly and you get the result, that's great, but how do you know it's right? You don't necessarily know. If you get a compile error and the code doesn't even run, then red flags are popping up. You can say, okay, there's an error here. I can't run the code. I have to debug it and fix it. If you run the code and there's a logic error, you might not know this is a mistake because the code will run and it'll spit out some kind of result, but it could be wrong, right? And if you don't understand the logic of what's going on here, you're going to have the wrong solution and you might not even know that, right? So it's good to really understand what these things are doing here. So I encourage you to do a little research. We have one data frame, another data frame, we're merging together on the left index, and we're doing an inner merge. So anything that matches is going to be merged together. Anything that doesn't match is going to be truncated off. Okay, if you do a left merge, everything on the first data frame is preserved. Everything that matches the second data frame is kept. Everything else dropped off. If you do it right, it's the opposite. Everything on this data frame is kept. All the matches are preserved. All the others fall off. And if you do an outer, then you get like more of a Cartesian product where you get everything. That's not what we want, right? Most of what we do is inner joins, but there are definitely scenarios where you need left, right, or outer, right? So we have the data pulled in. I'm going to create a plot right here. This is the S&P 500 versus the 10-year Treasury note. So the interest rate is on the left, 0.05 to 5. 10-year Treasury yield. This is the interest rate that the bonds are paying. And on the left, we have the S&P axis. So this is a dual axis chart with the blue being on the left, right, and the red being on the right. You can see the axes are very, very, very different measurements. It goes from 0.5 to 5 and from 2000 up to 6000. So very different measurements, but we can overlay them because relative to each other, this is how the plot would look, okay? So we have a correlation plot here. We can see a lot of these high, low, open are all highly correlated because these are essentially the same thing. If you go back and look at these numbers, here's the high, here's the low, here's the open. So these things are going to be highly correlated, right? These are high-low is the difference or the fluctuation in the price throughout the day. Sorry about that. The light cuts off here. I am in a room that has a motion sensor, so if you don't move around enough, the light cuts out, right? So yeah, so we have the correlation matrix. This line plot I think is very useful. You can see the trend is from the lower left to the upper right. From 2016 to 2024, this is the last 10 years. The S&P 500 has definitely gained from 3,000 to almost 6,000, so 100%. And the 10-year Treasury has gone from about 0.96, you can see that on the plot there, to 0.6, so about 600% gain, right? And the S&P went from about 1.8 to 4, maybe 200% gain there, right? 100. Yeah. Okay. So here's the correlation matrix. Kind of useful, not essential to have that. This is the first machine learning training that we're going to do. We're going to say this is the independent variable. X is independent, Y is dependent. So Y is dependent on the X. This is anything. This has to be dependent on the X, right? So you can have multiple features fed into the independent variable. This is the X. You can have only one on the dependent. That's the target that we're trying to predict, okay? So I run this. Now, again, I don't have the the code for the what was it, the Fred data source. So I'm not going to run it just because I can't share my API key with people here for obvious reasons. But I reran this everything. I refreshed this yesterday, and you can see right here we're getting a mean square error of 88.5814, and an R squared of 0.26. So the goodness of fit is only 0.26. This is the coefficient of determination. Coefficient of determination, and 0.26 is not very good at all, right? We want at least a 0.7 or higher. This model is essentially useless. It's not able to predict anything based on the independent variable being the 10-year Treasury and the GSPC being the S&P 500. And that's for good reason. Look, we only have one feature here, and we're trying to predict a feature, and you can see there's not a high correlation, right? There's some slight positive correlation here, 0.26, but as the S&P moves up and down and all over the place, the Fed is doing its own thing. The 10-year Treasury note is doing its own thing. They're really completely almost independent of each other. Not quite. The correlation would be 0.0 if it was. So there's a slight positive correlation between these, but very mediocre, right? So now we can go ahead and pull in the 5-year or the 1-year, 5-year, 10-year, and 30-year Treasury notes. Okay, and this is coming from, let me see here. Oh yeah, Yahoo Finance. Thank you, Yahoo Finance. It gives us most of what we need, not everything, right? So we have to switch back and forth between a couple different data sets to pull this data or to fetch this data from the web. But Yahoo Finance is very phenomenal. It gives us all the stock option data. You can see here we're getting treasuries, 1, 5, 10, 30-year treasuries. So I tip my hat to Yahoo Finance. They give us some good things. I'm always really blown away by the quality of the data and the breadth and the depth of the data that they offer. Sometimes going back, I think over 30 years, maybe 35 years of history for some of these stocks if they're around, right? If they IPO'd a few years ago, you're certainly not going to get that kind of time series. But if the stock was traded 30, 35 years ago, I'll bet Yahoo Finance has it. So here's the 1, 5, 10, and 30-year notes. Okay, so that looks good. Let us look for GDP. Okay, so GDP does not come from Yahoo Finance. They can't do everything, right? They have their limitations too, but we can get that from the World Bank. You can fetch that from here, go ahead and run it. This does not require an API. So I'm going to give this code to you. You can click this and run it. You will get all the data that you need from 2013 to 2023. I get 10-year time span, and I'm cutting off about a little over a year ago because when I go down here, this is the GDP data, GDP, okay, the inflation data. So we get this from Fred, the Fred API. You need your API key. I showed you where to get that, okay? So that cuts off at, looks like 2024, 11/1. So again, yeah, I wish the data was a little bit more current up to the end of 2024. We missed like kind of a year because now it's the beginning of 2025. But you know what, guys, it is what it is. This is all free. This is the best data we can get. We still can do a good analysis. We just won't have the most current data, but we have deep history. And for our purposes, it doesn't really matter. As long as we have enough history, 10 years worth of data is enough. We don't need yesterday's data or the day before. We have enough to make, to train our model and to test our model and to validate the model. You'll see that in a couple of minutes. So we fetched the Fred data up to the end of 2024. Okay, so we have that. So at this point, we are going to resample the daily data. This came from the S&P 500 and the 10-year, or wait, the treasuries, right? So here's all the treasuries, 1, 5, 10, and 20-year, right? So that's his daily. The S&P 500 is daily. We have to resample that data and basically roll that up to a month data and make that at the beginning of the month to match these dates, okay? So if this was month end, I would match that. It's month end, but it's month beginning. So I'm going to match that to the beginning date. This is month beginning. So all these dates have to match up, and we need this to sync up all of these different indices. So like if you imagine Microsoft Excel, if you start your data on row 1 and go to 2, 3, 4, 5, if the headers are all in row 1, it has to start in row 1. Everything has to sync up at a certain index, okay? So row 1 would be the index. If you're using headers in Excel, this is just an example. In this case, the index is going to be the dates in this data frame, and we just have what we have, right? We don't have any more recent data than this on December 1st, 2023. So everything has to end at that date, and then go back in time 10 years. Okay, so again, it's not ideal, but it is what it is, and it doesn't affect the analysis. So I don't really care about that, right? We'll go back in time a little bit, and we'll still have a decent model trained, tested, and ready to make predictions. So yes, so we're going to do the roll up here on the S&P 500, resampling by monthly, and we're going to take the first of the month, okay, and the monthly sequence, I believe that's what that means. So let's look at the example here. So here's a GSPC rolled up from daily to monthly, beginning of month, the beginning of the month. Okay, so we have that data. Now all the data is pulled into our Jupyter notebook, right? So we can start to align across the data frames. We have the S&P 500 resampled again for the beginning of the month, and we have the treasuries again resampled for the beginning of the month. We have the unemployment and the inflation, and those come in as the beginning of the month, right? So everything is going to sync up. That way we have the treasuries resampled. So 1, 5, 10, and 30 year. Okay, and we are going to have a start date with 2013 and the end date 2023. So we'll have a 10-year time span. Okay, and we're going to do the same for the Treasury and the GDP and the unemployment. Okay, so everything is we concatenated together. Here's the S&P, Treasuries 1, 5, 10, and 30, and the GDP is resampled all on the beginning of the month. So this is what we get. So we did a lot of work, but I think this looks nice. So let me actually validate this. I'm going to put this in Excel. I looked at this yesterday just to prove that this works. Okay, and put this in Excel. Now here's the trick. When you delete it, you can't just paste it into Excel. Okay, it's going to go in horizontal. So that has something to do with the formatting. I don't know exactly why or what or how or where that works, but if you put it in Notepad, cut and paste, then put it in Excel, everything's going to work. Okay, so just go to Notepad, remove the formatting. Has something to do with formatting. I know that because Notepad doesn't allow any formatting. So when you copy and paste it and then pull from the Notepad, all the formatting is deleted. So again, I don't know what causes that exactly, but there's some funky thing in there that does that. So if you go back in time, let's look at the GSPC. I'll prove to you how this works. So this is GSPC, and we have a couple of days. So 12/1, 11/1, 10/1. So if we go to 12/1, 23, 12/1, 159462. Okay, got it. So we got that one. Then we go back. I'm going to put a little green thing on here. Oops, I hit the wrong thing. Okay, I don't have to prove this, but I don't have to do this step. I'm just proving to you how it works. So when you run it, you can just run it because everything is set up. I already did this work for you. 4233785. 423785 right there. You see it? Okay. 428839. 428839. Okay, a couple of are same, they're not all the same. So I have confidence that that's working. Let's go back to the 1 year, 10, 11, 12, 1. So 1 year, 10, 11, 12, 1. Let me find out. I think it's over here. 10, 11, 12, 1. Yeah, 5.24. 10. Oh, wait, sorry. 12, 1. So it's 5.215. Okay. Okay, got it. That's good. 11/1. 5300. Oh, got it. Okay. We'll look at one more. 5315. Okay, it's cut off. Okay, if two are fine, then they're fine. 4705, that's the neighbor. 4789, that's next door. 4975. So I can see those on the screen. Those are all fine. Okay, that's what we're looking at here. So if I highlight it, boom, we got that. 4975, that's the 30, right? So those match up. Good. 4156, this is 12/1. If we go back to 12/1. 5215, 4156, I see that there. Okay, I'm going to make that green. And next door, we have the 10-year and then the 30-year, 4226, 4418. So we are good to go. Everything matches up. Let's validate just one more. I know it's right because I checked this already, but I'll just prove it to you. GDP growth, I think this is down, I think. Let me see. GDP growth for 12/1. GDP growth right there. 12/123, 2.88756. So we got it right there. Boom. So we are good to go. And they don't give us the dates, all they give us the years. So we're going to assume it's 12/1. We force that to be 12/1, right? For 2.88756 matches this. and we are good to go, guys. And we're going to use the same one for all these dates because it doesn't change for the year. You can see this is the same, 288,756, the same. So I think we're in good shape. Excellent, excellent. We did it. Mission accomplished. So let's go down a little bit more. So we have our merge data frame. We proved that it worked. Everything syncs up. We're in a good spot right now. We need we need the final merge of merge data plus unemployment, and then get the inflation. I think plus, this is not equals. That can't be equals. That doesn't make any sense. Okay, so we're merging these three together. There's the S&P 500, unemployment and inflation. Okay, so this is what we had before, just about a minute ago. Now we have the unemployment rate and the inflation rate, and let's look at these dates again. 11/1/2024. Oh wait, do we even have that? Oh, we don't. We have 2023. Okay, but you can tell these numbers are jiving up. You can tell that. Well, 3.8. Oh, we do have it. Okay, so 3.8 for 12/1/2023. Oh, we didn't put it in here. Okay, well, whatever. Just copy and paste it. So it came from over here. Going back in time a little bit before that period, and this inflation rate is, we are looking at 308.74 for 12/1, and I don't see that here, but you know what, that's fine. I know it's fine. I validated that all yesterday. So I think we're good to go. So we can get the merge data. We're going to create a feature from an existing feature. This is a closing price. I want to look at the returns. We're going to look at the percentage change times 100 to convert that into a full number right there. And we are going to look at the lag one, so shift back one, GDP growth, and unemployment rate. We want to go back one just to create a couple new features. So in the data science world, you have features that you work with. If you have, or if you're missing features, or you have a need to generate features that you don't have access to, you can easily create your own features. This is called a feature engineering exercise. We're going to create features from existing features. So we have a closing price. We want to get the returns. We have GDP growth. We want a lag of one, and unemployment, and a lag of one, just to see if anything is changing over time. Okay, that's the point of this thing. So we have our numbers over here. There's S&P 1, 5, 10, 30, GDP, unemployment, inflation, and S&P returns. So that is looking good. Here's the S&P returns, and then we created two new features. Remember, I just showed you that half a minute ago. GDP growth lag 1 and unemployment growth lag 1, and then we plot everything and we get this really cool looking chart over here. So anything that's orange, anything that you click on, it will disappear, and you click again, it comes back. Oh, here it is down here. So this is the inflation rate. Oh, this is the inflation rate, the red line. This is GDP growth. Okay, click, it disappears, click, it comes back. This is the S&P 500. Here is the unemployment rate, spikes up during COVID, right after 2020. Unemployment was off the charts. That was a crazy time. I'll never forget that. That was just an insane time to be in the United States. I don't know what it was like in other countries, but yeah, and Donald Trump was president back then, and he's coming back for a second term. Charting results in the plot, and everything looks plausible, looks very realistic here. I'm pretty happy with the outcomes here. Inflation is consistently going up, and you've seen inflation since the pandemic hit. It was probably 2.5 times up, maybe almost 3 times inflation for groceries and everything out there. Housing prices, cars, everything is more expensive now. So we created our first line chart to plot everything together. I think that came out good. I'm happy with the outcome there. Here's a scatter plot of unemployment rate and S&P returns, just to say, is there a correlation between the S&P 500 either increasing or decreasing relative to unemployment? And I think there is. There is actually a correlation here. Here, inflation is 2.5, unemployment is 7.8, and S&P is returns is 7.04. Now, if we go over here, unemployment is higher. We have 7.8. S&P is 7.0. Here, unemployment is 13.2. S&P is actually higher. I remember at that point, a lot of people were at home day trading. So I think initially, a lot of people were making money in the market just because everybody was putting all the money in the market. They're supposed to be working during the day, but They're working from home. There's no supervision. People actually day trading like maniacs. So the stock market jumped up all through 2020. I made a ton of money. Everybody that I know made a ton of money. But then as employment spikes up, the returns dip down a little bit, right? So as unemployment goes from 13 to 14, the return on the S&P, it's actually increased. S&P returns, oh no, negative. So negative 20%, right? So negative 20% when employment is 14.8. When employment spiked up, I think there was a lag. So people were getting into the market when employment was increasing, but then employment got to an all-time high in recent times. And then the S&P suffered, right? Because people were, I mean, there's only so much money you can trade, right? Like you put all your money into the market, and if you don't have any more money coming in, then the returns are dipping down. That's exactly what we see here. Okay, so negative 20% return on the S&P 500 long term with heightened inflation. So let's look at this OLS, ordinary least squared regression plot. We have the independent variables, GDP growth, inflation, unemployment, 1 year, 5 year bonds. You can put in a couple more, 10 and 30. I don't know if it makes that much difference. And then we're trying to plot S&P 500 returns. So let's see what the outcome is here. We can see here's the OLS statistical plot, or not plot, but the statistical printout result. The R squared is only 0.38, so it's pretty low. Only 3.8% of the variance of the S&P is explained by the model, so very low. P-value is 0.548, so pretty high. Again, not trustworthy. We want 0.05 or lower. We want R squared to be 0.7 or higher, so we're not even close to that. 1% increase in GDP is associated with a 0.93% of the S&P returns. But again, it's not statistically significant. The p-value is too low and the R-squared is too low. So there is a correlation, but very low correlation. 1% increase in inflation is associated with a 1% decrease in S&P returns. I think that makes sense. If inflation is increasing, stock prices are decreasing, right? Might help bond prices, but it's not going to help stock prices for a variety of reasons. Things are getting more expensive. It's going to impact the corporate bottom line, and their sales are going to fall and their profit margins are going to dip too, okay? So 1% increase in unemployment is associated with a 0.63% increase in S&P returns. But again, it's not significant, right? So we ran the model. All these numbers are pretty low. I want the T to be at least 1.96. This is kind of close, but not making a cut, 1.96. And all the P's are too high. We want this to be 0.05 or lower. This is kind of close, but again, not statistically significant. Oh, almost, but almost 0.52. And you can see that this P is pretty low. So lower is better, low is better. This is 1.96, 1.96 for the 5 year, but just barely significant, right? So we'll leave that alone. Let's look at another machine learning model here. So this is random forest regressor. Here's the independent variables. Here is the dependent. I'm saying 1, 5, 10, 30 GDP, unemployment, and inflation could have an impact on closing price, or we could use this to predict closing stock prices in the S&P 500. So let's run the model. We get a feature importance printout right here, and I'm going to plot that. Okay, I've got other videos on feature importance and random forest regressors and random forest classifiers. So I'll share all this code with you. I'm not going to get into all of the details of all of the model here and the training and testing and the refining of everything, because I have other videos that talk specifically to that. So check those videos out if you want to know the details, but I will give you the code. So if you want to run it, you can go ahead and run it and learn from this exercise. So you can see here the inflation rate by far has the largest impact on the S&P price, right? So as inflation increases more and more and more, the S&P 500 price will probably depreciate. Unemployment, 530 1-year GDP growth have no impact on the stock price rates whatsoever. But the inflation rate has a pretty huge impact. It's 94%. So close to 100%. Inflation goes up, stock prices go down. Inflation goes down, stock prices go up. Okay, and you see that in the current inflationary environment right now. You see it. So we can use this to make a prediction. The model is trained and tested right here. I've done this in a couple other videos. I show you how to do it. The model is making predictions right here. You have this Y predict. Let me do a Control F to find it. Here's the mean square error. Then we go down here. We can use the prediction to load in new data into a new data frame. So we actually have a dictionary here with key value pair, 1, 5.2, 5, 4.29. So that came from over here, 1 year, 5.2, and the inflation is 306. Let me see if I can find basically where that comes from. So I probably took it from the first line right here. So 1, 5.2, 4.2, 4, 4.1, GP 2.8, 3.7, 3.06. I probably just copied this. Probably that looks like where it came from. And then you can see the S&P 500 is 457672. Okay, that's important. So I put that into the model. Oh, that's a feature importance here. 306, these are numbers I just showed you. Run it 4572. That would be the actual number. The model predicts 454751. So that is close. Let's see how close that is. Equals divided by 4576, 4576.72 and 0.99. Let's subtract 1. Okay, division happens first. That's the order of operations. And you have a percent return of close to 1%, but is off by a couple decimal places. If you put the decimals on there, 0.06. So 0.6% off, pretty accurate. We're making pretty accurate predictions based on these independent variables right here, 1, 5, 10, 30. GDP, unemployment, and inflation rate, that's a tongue twister. And we're predicting stock price to the tune of almost perfect. We're off about 0.5%. That's the deviation right here. So the last thing I'm going to do is pull in articles from Google News to check the sentiment analysis for each of these articles. So this is relative to Apple. I said, give me all the articles relevant to Apple. And I'm looking at polarity and subjectivity. So subjectivity is how non-objective something is, how subjective is it, and how polarity or the polarity of something, is it very positive? That'll be 1.0, very negative, that'll be negative 1.0. In between is neutral, this is nothing. So this article right here, Apple struggle, can AI regain market share in 2025? It's pretty neutral, it's not positive or negative. This has a little bit polarity, so it's kind of like polarizing people, I guess, in the jargon used in this article. Soft guidance to keep, sell ratings, but pretty close to neutral. This has a slight subjectivity. Again, these range between -1 and +1. A lot of these are 0. You can see 0, 0, 0. This has a little bit negative right here, but just tiny, 3%. This is 0.5 positive, so a little bit subjective and not polarizing really at all. Can we add the market share? So yeah, so now we're going to add sentiment to our data frame, right? So we had the closing stock price, that's what we're predicting, 1, 5, 10, 30, GDP, unemployment, inflation, S&P returns, that's a feature that we created, the lag, the unemployment lag, okay, so on and so forth. Sentiment, polarity, here we go. So we're adding the polarity to see if that adds any predictive capability or enhances the predictive capability of the model. So we have the original independent features that we fed in, 1, 5, 10, 30. I've said this so many times. The new one's sentiment, polarity. Now we're trying to predict stock price. We run it 0.99%. So we went from 0.98. What was this thing over here? Oh yeah, 0.98. So R squared of 0.98, which is pretty accurate. I'm loving that. Remember the original one was like 0.2 something, 0.25. Now we're up to 0.98. So very happy with the performance. I'm thrilled with that. This is 0.99. So this is how good the data fits the regression line. And we're almost right there. It's almost perfect, right? So the predictions that this model is making is close to perfect now. So we got 0.9902, 99% accurate, close to 100. You never really get 100, honestly. If you get 100, there's probably something wrong. The model is probably overfit, maybe underfit, or you don't have a whole lot of data. The data set's too small, right? So the model is not really learning and generalizing to unseen data, and it's not really able to make accurate predictions. This model is able to make accurate predictions based on the R squared here. So here's the website where you can get the API. Go ahead, create one. It takes less than 60 seconds. Plug that into here. I think we can look for Fred. Control F, Fred. Where are you, Fred? Yeah, there we go. So put your API key there when you generate it, and you're good to go. You can run everything, and just hit the run button over here, this little play button, that guy, or run over here. Should be a notebook. Run all cells, something like that, and you're good to go. So that's it. Hopefully I was able to drop some useful knowledge on you guys. I think this stuff is pretty cool. All this economics and financial forecasting, economic indicators, influencing stock prices. We proved it beyond a shadow of a doubt. Good stuff, guys. Good stuff. Thanks for hanging with me to the end here. I think you have learned a ton if you made it this far. If not, maybe some people need to tap out and they can swing back later and and pick up the rest of it at some future point in time. So that's it. Thanks for your time. Enjoy the rest of your day. Goodbye.